Japan has a currency problem, and somehow America is getting pulled into it. Because the Japanese yen just fell to levels the world hasn't seen in decades. And when Japan tried to stop it, the United States stepped in. That sounds like a Japanese problem, but it isn't. Because Japan isn't just another economy. Japan is one of the biggest players in America's financial system. And what happens to the yen can eventually show up in American interest rates, bonds, markets, and even the cost of borrowing money. So how did a currency on the other side of the world become America's problem? To understand that, you have to understand what Japan did for decades. Japan spent years operating with extremely low interest rates. Money was cheap, very cheap. That created one of the biggest financial trades in the world. Investors could borrow Japanese yen at relatively low costs, convert that money into other currencies, and invest it in assets offering higher returns, including American assets. It became known as the yen carry trade. And for years, the system worked, until the yen started falling too far. By July 2026, the yen had approached a 40-year low against the dollar. Japan had a problem. A weaker currency makes imports more expensive. And Japan imports huge amounts of energy and other goods. So a falling yen can push up costs for businesses and eventually consumers. But Japan couldn't simply ignore it, so Tokyo intervened, and this time, Washington joined in. Japan and the United States coordinated one of their biggest currency interventions in years. Japan was buying yen and selling dollars, trying to stop the currency from falling further. But why would America care? Because currencies don't exist in isolation. They connect to interest rates. Interest rates connect to bonds, and bonds connect to the cost of money everywhere. And there is another detail that makes this story much more important. Japan is the largest foreign holder of U.S. Treasury securities. As of June 2026, Japan held roughly $1.1 trillion in U.S. Treasuries. That means Japan isn't just watching America's financial system, it is deeply connected to it. And here's where things get interesting. If Japanese investors decide they can earn better returns at home, they have less reason to keep money invested in American assets. And if large amounts of capital move, markets can react. That can put pressure on U.S. bond yields. And when Treasury yields rise, borrowing can become more expensive across the American economy. Mortgages, business loans, government borrowing, and the cost of financing almost everything. So the strange part of this story is that America doesn't need Japan to collapse for Americans to feel the consequences. The financial connection is enough. And that's why Washington's involvement matters. According to Goldman Sachs research, the U.S. intervention was not simply about deciding what the yen should be worth. It was also about financial market conditions, and the risk that volatility in one market could spill into others. In other words, America wasn't necessarily rescuing Japan. It was protecting itself from the consequences of a much bigger financial chain reaction. And there's an even deeper problem. Japan has spent decades fighting weak growth, low inflation, aging demographics, and enormous government debt. Now inflation has changed the situation. Japan can't keep rates extremely low forever, but raising rates creates problems too. Higher rates make government borrowing more expensive. They can pressure financial markets, and they can make the yen more attractive, but potentially at the cost of economic growth. So Japan is trapped between two uncomfortable choices: protect the currency or protect the economy. And America is watching closely. Because the global financial system has become so interconnected that one country's monetary problem can quickly become another country's market problem. That's the real lesson here. The biggest financial risks don't always start in America. Sometimes they start thousands of miles away. A weak currency, a bond market, an interest rate decision, a trade that looks profitable for decades. And then suddenly, all of those pieces connect. That's why Japan's yen crisis matters to Americans. Not because Japan controls America, and not because the United States is about to collapse, but because modern finance has created something much stranger. America's financial stability can be affected by decisions made in Tokyo, and Tokyo can be affected by what happens in Washington. The two economies are connected through currencies, capital, bonds, and interest rates. So the next time you hear that the yen is falling, don't just think about Japan. Ask a bigger question. Where does Japanese money go next? Because if that money moves, American markets may feel it. And that is the part of the story most people never see. The world economy isn't a collection of separate countries anymore. It's one enormous financial network. And sometimes, a problem that starts in Japan doesn't stay in Japan. If you want to understand money, business, psychology, and the economic changes happening before most people notice, subscribe to Profit Explain X, because the biggest financial stories often begin somewhere you weren't looking.